Now let's consider some insights from microeconomic theory for the demand for health insurance. The microeconomic perspective on the demand for health insurance will help us understand the drivers of demand or how much someone is willing to pay for health insurance. It will also help us understand whether individuals will purchase health insurance if the full premium is not actuarially fair. That is, if a part of the premium covers administrative expenses or insurer profits rather than only the expected healthcare expenses. So to understand the demand for health insurance, we first need to introduce the concept of utility. Utilities are theoretical measures of an individual's level of satisfaction, say from the consumption of goods or services, or from income and leisure. One example from microeconomics is that individuals seek to maximize utility from consuming goods and services subject to their budget constraints. Regarding the demand for health insurance, we typically examine the utility of wealth, which allows individuals to purchase goods and services now or in the future. Suppose that the individual receives utility or satisfaction from wealth according to the following utility function. Here, we're effectively mapping the level of wealth to a level of utility according to this formula. So if wealth is $100, for instance, a utility of that level of wealth would be 10 in this case. Note of this utility function implies that utility increases with wealth, but at a diminishing rate. So as we'll see, the individual experiences diminishing marginal utility of wealth. And as you can see that in utility wealth space here. So for that first $100 of wealth, the individual's level of utility is 10. But if you double wealth from 100 to 200, you don't double the level of utility. So you can see here that utility is rising with wealth, albeit at a diminishing rate. So that's diminishing marginal utility of wealth. And this is important in the context of the demand for health insurance, because for demand for health insurance arises from healthcare expenditure, risk, and risk aversion. And a diminishing marginal utility of wealth, that is a concave utility function and utility of wealth space as shown here, implies that the individual is risk averse. So let's review a few technical matters first. If utility is equal to the square root of wealth, for example, each incremental increase in wealth leads to a rise in utility, but at a diminishing rate. And so you can see the level of wealth, the level of utility, and what is marginal utility or the change in utility given that incremental change in wealth. So this is what we're referring to when we say there's a diminishing marginal utility of wealth. A marginal utility is the change in utility given a change in wealth. And you can see where that is diminishing in marginal utility wealth space. In this particular case, the individual is risk neutral. There's a linear utility function and a constant marginal utility of wealth, which implies utility increases with wealth at a constant rate. And here, the individual is what we call risk loving. This implies that there's a convex utility function and a utility wealth space and an increasing marginal utility of wealth, or the idea that utility increases with wealth at an increasing rate. Now, risk-loving preferences are quite rare in the context of the demand for health insurance, so we'll be focusing on the case where preferences are either risk neutral or risk averse. So again, when an individual is risk averse, we have a concave utility function and utility wealth space, a diminishing marginal utility of wealth, or the idea that that utility increases with wealth at a diminishing rate. Here you can see all of these different risk preferences and marginal utility on this chart. Again, we'll be focusing mostly on risk averse and risk neutral preferences and something in between in order to figure out the demand for health insurance. Here we have utility and wealth. And again, utility is just equal to the square root of wealth in this example. And so let's focus on this area within the rectangle. This slide just zooms in just to get a better look. And then suppose that the individual's initial level of wealth is $40,000. So the square root of 40,000 is 200. And so you can see how wealth is being mapped to utility according to that utility function, where utility is equal to the square root of wealth. So with initial wealth of $40,000, let's suppose the probability of illness is 0.5 or 50%. And further suppose that healthcare expenditures, if ill or injured, would be about $30,000. So that implies that wealth, if ill or injured, would decline to $10,000. So given the probability of illness and healthcare expenses of ill, the expected loss of wealth for this individual is $15,000. That's the probability of illness multiplied by the healthcare expenses if the person is ill or injured. And this for a risk-averse individual with utility equal to the square root of wealth utility of the initial wealth is 200, and utility if ill or injured, where wealth would drop down to $10,000 after incurring $30,000 in healthcare expenses, that level of utility would be 100. Let's look at this mathematically. So if WH is going to be wealth if healthy, WI is wealth if ill or injured, P is the probability of illness or injury, which ranges between 0 and 1. This is expected wealth. This is expected utility of wealth. So if we want to calculate expected wealth, which is shown here, that is simply the probability of illness multiplied by a wealth if ill or injured plus 1 minus the probability of illness. Or, in other words, the probability of wellness multiplied by wealth if healthy, and then we can also calculate expected utility. So the expected utility of wealth is the probability of illness or injury multiplied by the utility of wealth if ill or injured, plus 1 minus the probability of illness or injury multiplied by the utility of wealth if healthy. Now let's plug in the numbers from our example. WH is 40,000, WI is 10,000. The probability of illness or injury is 0.5, and we can calculate expected wealth and expected utility given those figures. So expected wealth, as we saw before in this case, we would have a 50-50 chance of either having 10,000 or 40,000. So 40,000 plus 10,000 divided by 2, that's expected wealth of $25,000. For expected utility, again, a 50-50 chance of either having utility of 100 under that lower level of wealth or utility of 200 under the higher level of wealth. And expected utility here would be 150. So this chart shows different probabilities of illness or injury and the expected wealth or expected utility under those probabilities. So you can consider what that would be under all kinds of different situations. In our case, with initial wealth of $40,000, the expected wealth would be right in between the wealth of $10,000 and the wealth of $40,000. So expected wealth of $25,000. I'm given that probability of illness of 0.5, and in this case, the expected utility is also 150. And if we can see that on this green expected utility line, that would be our expected utility. But note that that certain utility of 25,000 is going to be higher than the expected utility with risk of expenditures on healthcare without insurance. And so in this case, for a risk adverse individual, utility of $25,000 is approximately 158. That means that for a risk averse individual without risk of a certain $25,000, which is approximately 158, it is greater than expected utility with risk, which is exactly equal to 150. Or stated differently, the utility of expected wealth is greater than the expected utility of wealth. Given the extent of risk aversion, this individual will be willing to pay $15,000 for an actuarially fair premium. That's a premium based on the expected healthcare expenditures with a 0% coinsurance rate. And this individual would also be willing to pay an extra $2,500 to cover loading costs, which would include administrative expenses or insurer profits, for a full premium of $17,500. And that's because a certainty utility without risk of $22,500, which is equal to 150, is equal to expected utility with risk, which is also 150. And wealth with insurance will be less than expected wealth without insurance. But this risk-averse individual is willing to pay this risk premium of the difference between the two of $2,500. This individual is willing to draw down initial wealth from $40,000 to $25,000 because that would give them the wealth they would expect with the risk of major healthcare expenses, and then they'd be willing to pay the extra $2,500 because that will leave them with a guaranteed $22,500, which would give them a guaranteed utility of 150, which is exactly equal to expected utility with the risk in place without insurance. Again, let's look at this mathematically. CE is going to be the certainty equivalent, or that level of wealth with insurance where the utility of the certainty equivalent is equal to the expected utility of wealth. In this case, the utility of the certainty equivalent is equal to the square root of the certainty equivalent, given the functional form for this utility function. Let's set the square root of the certainty equivalent equal to expected utility, and then we can solve for the certainty equivalent, or that level of wealth with insurance where the individual is getting a certain utility which is exactly equal to expected utility with risk. So here, the square root of the certain equivalent will be set equal to the expected utility. We know that expected utility is 150. Let's square both sides so we can solve for the certainty equivalent. And in this case, I've shown that before that would be equal to 22,500. The risk premium is simply the difference between expected wealth and the certainty equivalent. So in this case, expected wealth was $25,000. The certainty equivalent was $22,500. And that leads us to a $2,500 risk premium that this individual is willing to pay above and beyond the actuarially fair price for health insurance. So the individual's maximum willingness to pay for health insurance, that is, the individual's demand for health insurance, is the difference between wealth, if healthy, and the certainty equivalent, that level of wealth with insurance, which would leave them the level of utility which would be equal to the expected utility under the risk of major health expenses. So in this case, we start out with wealth of $40,000. The certainty equivalent is $22,500, and that implies that this individual will be willing to pay at most $17,500 for health insurance. The individual would draw down initial wealth to expected wealth, and that would be actuarially fair or reflective of the expected healthcare expenses for the individual. But then they'd be willing to pay the risk premium of $2,500 to get to that certainty equivalent. That's how risk averse this individual is. So again, the risk premium here is the difference between expected wealth and the certainty equivalent, or $2,500. And that's why this risk-averse individual is willing to pay that full premium of $17,500. Now, a risk-neutral person that has that linear utility function and utility wealth space, this individual would only be willing to pay the actuarially fair amount. They're not risk averse, so they're not willing to pay the risk premium. They would only be willing to draw down their wealth to expected wealth given the risk of the healthcare expense. Rather cryptically, one microeconomist writes that if an individual is risk neutral, the expected utility of wealth is the utility of its expected value. So expected utility of wealth equal to the utility of expected wealth. So this implies that the maximum amount risk neutral individuals would be willing to pay for insurance is determined solely by the value of the expected loss, and risk neutral individuals would only be willing to pay that actuarially fair premium at most. So to summarize this rather technical exploration of the demand for health insurance, how much are individuals willing to pay for expenditure risk protection? That is, what is the demand for health insurance? Well, risk-averse individuals are willing to pay premiums for health insurance that exceed their actuarially fair values. That is, the more risk-averse the individual is, the more that person is going to be willing to pay above and beyond the actuarially fair amount for health insurance. That's the case even though wealth with insurance after a full premium has been paid is less than expected wealth without insurance. On the other hand, risk-neutral individuals are not willing to pay more than the value of the expected loss, that is, the actuarially fair premium for health insurance coverage. However, in practice, no insurance company would be able to provide coverage in this case, as loading costs are a necessary component of doing business. This implies that the first person to drop out of the insurance market when premiums increase are the relatively less risk-averse individuals, as was stated in another textbook on healthcare economics. We also see the willingness to pay an amount above the expected loss will be low when the probability of illness is extremely low. In this case, expected utility is quite close to certainty utility at the top of the curve, and the individual's willingness to pay a premium above that actuarially fair amount will be quite low. That's also the case when the probability of illness is extremely high. In this case, expected utility will be quite close to certainty utility here at the bottom of the curve. and the individual's willingness to pay a premium above the actuarially fair amount will be low. And this is because the individual may prefer to save what would have been spent on health insurance and pay out of pocket for health care rather than pay the loading costs that are added on to the premium by the insurer. And you can see both cases quite clearly on this chart. When you have a very low probability of illness, that risk premium that the individual is going to be willing to pay is going to be quite low. And that's also the case when you have a very high probability of illness or injury. In other words, the gap between certain utility and expected utility is quite small. And it's going to be maximized in this case when the probability of illness is 0.5, or basically a coin flip. So here are the takeaways. With all else being equal, if individuals are sufficiently risk averse, they'll be willing to pay more than the actuarial value of a health insurance plan. But if they're not very risk averse, or if they're risk neutral, they'll be fairly responsive to changes in health insurance premiums. In the case above, with an actuarially fair premium of $15,000, the individual's only willing to pay $17,500 at most for health insurance. And if the only option in the marketplace is a policy with an $18,000 premium, the individual will not purchase health insurance in that marketplace. Several factors ultimately influence the demand for health insurance, including employment status and access to employee-sponsored health insurance plans, workplace location, risk aversion, uncertainty, and income. And with regard to income, individuals with low income have limited ability to pay for insurance, and individuals with high income might be able to self-insure. So we might see relatively low demand for health insurance among those with both low incomes and high incomes. The price of insurance will also influence demand. So an individual may be more likely to purchase health insurance if it's fairly priced, set at close to an actuarially fair level with a low loading factor. It would also depend on the probability of a health event, as we saw before. The magnitude of potential loss could influence an individual, and they might be less likely to purchase insurance for health conditions that result in small financial losses, say routine visits to the dentist's office. Tax treatment may also influence their decision. In effect, the tax exclusion for employee-sponsored health insurance in the U.S. reduces the cost of insurance because the premium contributions by employers and by employees for employee-sponsored health insurance are tax exempt. So mathematically and graphically, I've included all the notation and formulas in the appendix and lecture slides. I've also shown what all of those formulas and notations look like graphically here as well. Here ends the presentation for Chapter 8, Part 2.